We start up by firing the fast money time machine. You might remember back in December when we asked our traders to pick the acronym they thought would rule in 2021. Take a look at how they've done. Tim's acronym so far has been the strongest. That would be RISE, Rio Tinto, the IWM Small Cap Index, Schlumberger, and Emerging Markets. That was up more than 21% so far. Dan here chose ABIDE, which would be Amazon, Alibaba, IPOC, which is Chamath Palihapitiya's SPAC that merged with Clover Health, Disney, and Expedia. That is up about 5%. And rounding out the acronyms was Karen's WTF. Not what you think it is. Walmart, TJ, FedEx, TJ Maxx, and FedEx, that's up 3%. So what are the themes that have worked so far this year? What is going to rule in the second half of the year? Dan, I'll throw it to you. You're in a solid second place there.
Not so solid, Mel. We had the S&P 500 close up close to 15% of the year, so up 5%. It just shows you how difficult stock picking can be at times. You know, I was really interested in Amazon and Alibaba as kind of first half things. Really disappointing. I mean, when you think about it, that seemed like kind of a layup for, like, you know, this consumer that's in great shape both here and probably abroad. That didn't work particularly well. Disney reopening trade, again, it's basically flat to down a little bit on the year. And then you have something like Expedia that actually worked really well. And then, you know, on the SPAC side, that's going to be fits and starts here. We're going to see a lot of interesting stories that do well, some that don't.
Right. I mean, when we asked you guys to pick them, SPACs were the hottest thing under the sun. And so that obviously has fizzled. Also, we had fits and starts when it comes to interest rates. We had them go spike higher to 1.74%, which really sort of threw a wrench in some of the tech trade here. Karen, what were you thinking when you thought of What were you thinking? WTF with your WTF at the time. And do you think that's going to revive in the second half?
Well, what WTF really should have been was Weight Watchers, Target, and Facebook, which would have fared a lot better. So, yeah, frustrating. Definitely the F, FedEx, I'm staying with that. We've talked a lot about that in the last week. I really like that. So I'm sticking with that. TJX has been disappointing in the retail rally. It really hasn't participated as well. Primarily, e-commerce has never been their thing. The treasure hunt is obviously part of their appeal. So that's been slower as reopening in person has been a little slower than I thought it would be. I'm sticking with that as well. The Walmart had a nice run the other day. I guess I want to change there to ATF, the A being alphabet, and alcohol, tobacco, and firearms seemed somewhat catchy as well. So that's where the A is alphabet. And I just think that I know we're going to talk about inflation, but the kind of trades that can do well in growing GDP, but also potentially growing inflation. So and I think the valuation there, despite it having run up, is still not particularly expensive given how extraordinary this business is.
So already
that's
you're pivoting.
Where I am now.
Yeah, you're pivoting away from Walmart.
Yeah.
Tim, you really benefited by having the foresight to lean into the energy trade, to really lean into the reopening trade.
Well, the sense that I had, and I think despite some of the on-again, off-again elements of the Treasury bond market telling you maybe we don't have as much growth, GDP in the U.S. is going to grow 6.5% to 7%, not just this year, but next year. And to me, that reflation trade, and even though commodity prices got well ahead of themselves, and we've talked about lumber and we've talked about copper pulling back, I think you still have a dynamic here with both reflation and absolutely in energy prices. OPEC this week, or even today, I should say, is seemingly punting, doing any kind of an output cut, while the developed world, not the emerging world, not the developing world, is seeing demand that it hasn't had in a long time. That's going to continue to put energy prices higher. In fact, we came into this underinvested into energy. So, yeah, I like the energy trade. I like the reflation trade. I like small cap and growth. And I do think emerging markets can continue to run.
All right. Well, we fired up the fast money time machine not to skewer anybody for picking a bad acronym, but really to discuss the themes that worked in the first half and the themes that could continue to work in the second half of the year. So, Mike, you didn't have an acronym at the start of the year, but seeing these acronyms, which themes do you think will continue to work?
Well, I mean, I still like the energy space. I like what Tim, I think I see the same things that he does there. I actually like a lot of the names that Dan has on his list. And if I was creating a new acronym now, a couple of them might be on it. Certainly, I mean, Baba, I've actually said, I think it's an interesting value proposition right here. It's not particularly expensive, remarkable growth opportunity. Amazon, I don't really think I need to explain to everybody that this is a company that has successfully grown into its valuation and continues to. It's in all the right places. We're actually looking at not only top line growth, but margin growth as well. And obviously their exposure in the cloud space. So I definitely like those two names. And Disney, I mean, to me, what's interesting about this is that, of course, the reopening trade, I think, is largely played. I think we're kind of done with that. But that's not the thing that I see with Disney. I look at the valuation of a company like Netflix, and then I think about something like Disney Plus, and I say, okay, well, Disney Plus is likely growing faster than Netflix is, so I want to attach a higher multiple to that business than I would to Netflix. And then the rest of the company begins to look pretty cheap. So I think Disney, I definitely would pick that one. I like the energy space generally. I didn't pick Schlumberger at the beginning of the year, but I'm a long-time holder of Halliburton. So that's kind of a correlated trade there.
Yeah. I have a new one, Mel. Can I do it?
Do it.
I don't know. I missed the call earlier today. I don't know. And this one is kind of like an ode to you in a way. I'm going to call it apes. APES, okay? Because you kind of, aren't you the queen of the apes? Isn't that what's going on in the Reddits and stuff like that?
People call me
All right, so here's my new one right here. It's AMC. I think you sell it here. A $28 billion market cap, and I know that the apes, that's not what they do. I just don't see this thing with $11 billion in debt. They can continue to raise as much money as possible. Just relative valuation, not going to work here. So that's the A. P, Pfizer, okay? Boosters, that's going to happen. We're going to do that for the vaccine boosters. Okay, so there's your P. Then I have an Exxon. I'm going to take the opposite side of you guys. I don't like the large integrateds here. 6 to 9 months ago, we were talking about how they're going to defend their dividend, and now all of a sudden, these things are making new 52-week highs. So I'm a seller of Exxon. And the last one is SoFi. It was my final trade the other day, final trade last week. I think, and we're going to talk about Robinhood a little bit, I think that some of these fintechs and some of these entrants to the market and stuff, the valuations that they're getting, SoFi should have higher valuations.
To be clear, liking oil, liking Schlumberger, and liking Halliburton is not liking Exxon, Conoco, and Chevron necessarily. Exxon in particular, and that is because they are obviously benefiting from higher oil prices, but they're not replacing their reserves. They obviously are trying to maintain their dividend. They have a huge amount of debt, and you can't service the needs of all of those three things simultaneously with the cash flow that they have. You can either pay the dividend and pay down debt and then not replace your reserves. So you have to do some mixture, but there's a compromise there, and I don't really see Exxon as a great investment.
Yeah, I mean, Tim, and Tim, you are also in some integrateds, I believe, but really, if you wanted to play this move above 75 in crude, I mean, the more levered way is obviously to go with names that are in an OIH as opposed to the big integrateds.
Yeah, I just think that the oil services is your higher beta play on higher energy prices. They have absolutely underperformed on a linear basis to the oil price. Maybe you can't extrapolate that, but I can tell you that they've massively underperformed a move in crude, which to me is a function of many things, right? It's not just that we're reopening and that there's more demand. It's that it was underinvested. So look, I love Schlumberger because they have the best balance sheet in the oil services. They are the technology leader. I think they've showed enormous kind of capacity and capex restraint and capital discipline at a time when I think this is still a really exciting space where there is innovation. So to me, some of these trends on commodities and emerging markets are things that these aren't short 1 year or even shorter trades. I think we've seen long cycles. They are long cycles, and it took a long time and obviously a lot of pain to build up to a place where the fundamentals switched. Then you've had these catalysts, whether it's been COVID, et cetera.
Karen is raising her hand, which is uncharacteristic. So, of course, Karen, go ahead.
Yes. Well, let me just play devil's advocate for a moment. So oil, obviously, that was a big headline today. But let's look at, we're in backwardation, right? If we look at oil out June of 22, it's 67. So does that, to me, that's not the best sort of ballast for the oil continuing to go higher story. Just playing devil's advocate here.
Tim?
You want me to respond?
Yep.
Yeah, well, I think you have a case here where, first of all, the curve didn't price in $75 oil either. I think you've got a case where, look, positioning is wrong on this, and the expectations that it's going to take longer for infrastructure and some of this capacity to actually be to follow through on some of this demand. I think there's also not a view that the demand we're seeing is sustainable. That's why the curve reflects that. And I guess, again, the oil curve has been wrong many times. I'm not, Karen, you're never wrong. I'm not going to accuse you of being wrong here. But to me, again, the setup for energy companies is, well, this has all been about underinvestment. And then from a market's perspective, it's been all about underweight. And these are companies that are not going to burn you the same way, in my view, because they can't. They have different capital approach. They have different capital efficiency.
If you believe, though, that the curve has been wrong, and the curve is wrong, Karen, in terms of the future price of oil, and it actually would be higher than 67, then what impact does that have, if any, on your view of the consumer?
I think it's starting to get a little worrisome for the consumer. I mean, we'll see how quickly gas prices. I don't know if someone sent me a photo of gas prices. I don't know if we have that in Menlo Park, right outside Silicon Valley. Pretty high, right? And at some point, that really starts to eat away at the consumer's buying power. We haven't seen it yet, but consistent prices that high will do it. Not a spike, but consistent prices. So that concerns me a little bit.
I don't think we need to worry about $5 gasoline prices in Menlo Park, where everybody's rolling around in Teslas these days and probably could afford the $5 gas, even if they weren't. The important thing to remember about the curve in the futures market is that backwardation simply tells you that demand is outstripping supply in the near term. And it's generally viewed to be a bullish signal for the underlying commodity. If you take a look at some of the worst markets that we've seen in crude, you're going to see steep contango markets. That's when the spot and the near-dated futures trade well under, and that just tells you that there's oversupply, and that creates some overhang. It takes a while for production to ramp. Sometimes when you see the curve in backwardation, that is actually just reflecting how much time it takes for supply basically to come online to service the anticipated increase in demand. I think that the fundamentals still remain strong, though. We are obviously in a growing economy. Demand is coming back in a big way, and it's going to take a little while for the commodity markets to keep pace.
Shepard Smith here. Thanks for watching CNBC on YouTube.